Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to give you an update on the portfolio, talk about a few things that are happening, and maybe what you should do during this week. So if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. So hopefully you guys did enjoy my last video where I talked about how much I earned on YouTube. I know it was a request, and so I put it out there. So if you have any more requests, please put them in the comments down below, and I'll be happy to possibly make those types of videos. So on that, guys, for the day here, the portfolio for the week, actually, portfolio closed out at $10,690.57. We are down $56.71 for the day, down 0.53%. For the 1 week, we are down $183.20, down 1.68%. For the 1 month, we are up $36.77, up 0.35%. For 3 months, we are up $724.57, up 7.27%. And for the 1 year, we are up $2,035.74. And for the all-time, since starting this portfolio, we are up $2,360.34, up 28.33%. So for the day here, we did have a good rise, but a sharp drop off during the middle of the day there. Yeah, right in the afternoon, just kind of dropped off there, but we are doing just fine. I know there's probably some more fear in the marketplace due to potential future monetary policy changes. And what that means is I'm talking about the increase of possible interest rates, not just in the US, but also in Canada. And I know they did put that off for next quarter and see what happens, sort of thing. But what that means is it's going to be costing more money to borrow money. And investors are in fear of that. And I know we'll talk about it in the end of the video. I guess I'm getting ahead of myself. But let's talk about really the activity that we have going on here. So we did make a purchase today. We did purchase BCE, which is Bell Canada. We did buy VFV, as we always do this year, starting this year. At the beginning of the year, I said I would buy VFV, which is the S&P 500 Vanguard fund, every time we purchased a stock. And so today we purchased 1 share of BCE. Today it closed out at $66.66. It was up 18 cents on the day. And we purchased it at, I guess I have too much activity there. We purchased it at $66.68, so a bit higher than what it closed out at. And then we did make a fractional purchase here on VFV, which we, again, no activity there. I wonder why they moved all that stuff. But VFV, we did buy a fractional share of 0.2497 shares at the price of $100 and about 10 cents. And we bought $25 worth of VFV. Sorry for the movement around. I didn't realize they made some changes there. And in the cash account, we do have $47.05. So that is the portfolio update. We'll go ahead and head over to trackyourdividends.com to give you a look-see at what we are to expect for the year when it comes to dividend payments and how we can always increase that. So last week, the portfolio was closed out at $10,510 with a capital appreciation of $2,398, dividend yield of 3.25% if you're to build this portfolio as it stands right now. Yield on cost that we got is 4.21 because we used the strategy of dollar cost averaging. I'm probably going to make another video on that in the near future, just an updated version, as financial literacy can be super dry, and we'll try to make it a bit more entertaining. Okay, annual income last time we updated was sitting at $342. So we did make a purchase of BCE. So we'll go ahead and add a new holding. Ticker symbol for this is BCE, as you would guess, .to. There it is. We bought 1 share today, and we bought it at $66.68. Go ahead and add that holding. And we'll also add VFV to the pile. So VFV.to. And we bought not one share, but 0.2497 at the cost basis of $100 and 1046. Go ahead and add that holding. So as you can see now, the portfolio is at $10,601. Dividend yield sitting at 3.26 if you're to build it today. Yield on cost is 4.21%. Annual income has increased to $346. As you can see here, BCE updated to 15 shares. Profit of $94.35 if I were to sell. Dividend yield at 5.25 today. Our yield is 5.8, and our annual income from BCE alone is $52.50. Average cost of getting in is $60.37. We'll head down to VFV. We have now 1.48, almost 1.5 shares. Today closed out at $99.92. Our average cost is $101.42. We are down $2.22. And our annual income is $1.67. So that is the portfolio. On track your dividends. And our annual income is $346, which is what we're pretty much looking for as we continue to build a dividend portfolio right in front of your eyes. So go ahead and close that out, and we'll head to ShareSite. So ShareSite I already updated, but we're doing pretty well on this side of things as the market is dropping. For a lot of people, I know these past few days, it was on a little cycle of trending upwards, but we did lose a lot of value today. Not too much, but something that we're used to in 2022. So as it stands right now, we do have a capital gain of 259, so a market increase of 2.59% in the portfolio. Dividends do get accounted for this, so we have 0.32% of dividends that have come in, and currency gain, which is the currency forex or foreign exchange with the US stocks that we hold in the account. That's up 0.15, so we are still in the black. And our total return in this calendar year, as you can see up here, is 3.07%. So to be honest, I'm not mad about that. I know for a lot of people, the market is down for them this year, and it's okay. It's all right. So we'll head over back to Wealthsimple Trade here and just talk a little bit more about what's going on. And so, like I said close to the beginning of the video, monetary policy, which is the Fed and everyone else that plays a role in the marketplace, in currency, in the financial markets. They are planning on increasing interest rates. That's old news. Everyone knows that. But the market is always an indicator of what investors think is going to happen in the near future. It is not a direct correlation with what has already happened. And so there are a few factors that play into this. So if interest rates rise, that means it will cost more to borrow money, or any existing debt will cost you more money. And so when they do that, a lot of people will essentially lose the wanting to borrow money, because some people do leverage investing. They borrow money to invest, or they do other things where at some points it was relatively cheap to borrow money. And so right now, I think what's happening is investors are fearing that interest rates are going to go up. Inflation is a big factor in all of this, and it's going to cost more to borrow money. And a lot of times companies will borrow money to build and expand their company to increase growth. And so if it costs more money to borrow money, then really it just doesn't make sense, because it does hurt their bottom line, because they do eventually have to pay that back. And this is all part of understanding and learning about how companies work, how the financial markets work, how the market and the economy work, and how monetary policies work. And so that is one of the biggest factors. But another factor is that January, because it was a new year, a lot of big profile companies, a lot of companies we know like Netflix, and a lot of hype companies that were pretty large reported earnings and kind of projected what they're expecting for this year. And a lot of the projections were not very impressive. I mean, for Netflix to fall like 40%, and talking about how they're only going to have I think it was like 2.5 million or something like that subscribers for this year, new subscribers, which is almost half of what they projected last year, based on where the economy was. This year, a lot of people are not staying at home to work anymore. They're not at home. They're out trying to find jobs or back to work in the office. And there's no time to be at home to be watching continuous episodes of whatever show you're watching. And then Peloton also dropped, which I'm not a big fan of anyways, but I'm going to talk about it anyways. It's the closest thing that I can relate to in-home gyms, because a lot of people wanted to do that as they were stuck at home. But now people are going back to the gyms and paying for memberships there. And so there's just a shift happening, and that is playing a factor in a lot of what's happening in the marketplace. Now, what should we do in times like this? And to be honest with you, I think if you have high interest debt or any kind of debt that can move with interest rates rising, you probably want to try and pay those down as quickly as you possibly can, because it's just going to cost you more to own it. And I'm talking maybe like lines of credits, mortgages. If your mortgages come up for renewal or something like that, maybe lock it in for another 5 years before they start raising interest rates, because it's bound to happen. That's just how the economy works. The last time Canada had interest rate increases, I do believe it was like 2018, and they increased them quite quickly. If you have the ability, whatever you do, try to increase your income, pay down some debts, and continue to invest. If you have high interest debt, try to pay that down, because we know credit card interest rate has gone up in some places. It used to be 19.99 for a lot, but now it's 20.99, and you can find other credit cards as well. And again, this is not financial advice. This is just my opinion. Best strategy in times like this, pay down as much debt as you possibly can. And I don't know what stage of life you're in. I don't know what you're going through financially, but whatever you can do to try to increase your income, try to put some money away for a rainy day fund, emergency funds, pay down as much debt as you possibly can, especially if it's high interest debt like credit card debt, and then low interest debt as well. But continue to invest, because right now is the opportunity to do that as the market is down. And who knows if it continues to go down or if it'll start going back up. But from what we've heard and what is the trend in the market, it seems like everyone has a little bit of fear, and it's very volatile as of today for the past month, since the beginning of the year. And continue to dollar cost average your way into positions and in companies that you have done your due diligence on. What I mean by that is research, learn about the company, and really investigate the company like it's your own company, and figure out what they need to do or what you need to do to make sure that company thrives and continues to grow, to keep shareholders happy, and to continue to pay down debts as companies would, and how they can still afford to pay out these dividends. Because if these companies do not have a cash flow, and they have a negative cash flow, or they're losing money, they will not be able to pay out what a lot of us who are watching this channel will never ever get our dividends. But just treat it like that. Do your research. Time to learn some new skills and increase your income, lower expenses. I'm sure you've heard the spiel before, but other than that, guys, that's the update for the end of the week. So have a great week. Do not panic, and we'll see you in the next one. Bye.